Welcome to BSB's Deep Dive, the podcast where we break down research papers, books, and market strategies to help you invest smarter. I'm Natalia, and every week we explore ideas that sharpen your mind and grow your wealth.
Welcome to the Deep Dive. Today, we're really zeroing in on a core strategy in investing, value investing. It's basically about, being smart about buying stocks, finding those companies that might be overlooked, solid long-term prospects, but maybe the price isn't quite there yet.
Buying quality on sale, essentially.
Exactly. And for you, our listener, if you want to really get this inside and out, especially the strategies that could, inform your own trading plans, that's what we're doing today.
Yeah, we're trying to cut through the jargon.
To the heart of it.
Exactly. We're diving into this paper, Value Investing, a Modern Approach. The goal is to really unpack its findings, especially around this idea of intrinsic value.
The intrinsic value, right. The company's real underlying worth.
Precisely. And how figuring that out can, guide your investment choices. The paper helps by looking at 4 big names: Microsoft, Apple, Pfizer, and Merck.
Okay.
All viewed through this value investing lens.
Great. So let's jump right in. What, in simple terms, is value investing?
Well, at its core, it's about finding stocks that seem to be trading for less than they're actually worth. It's a strategy that encourages looking beyond the hype.
So not just following the crowd.
Right. Look for solid businesses the market might be sort of underappreciating. And the paper mentions something key here: investor behavior. We, as humans, tend to get excited about stocks that have already gone up, right? Sometimes we push prices too high.
Momentum chasing.
Yeah. Value investing kind of pushes back against that. It makes you actively search for opportunities maybe others are ignoring, or companies facing temporary issues but still fundamentally sound.
So it's about being a bit contrarian, finding value where others aren't looking.
That's a good way to put it. The paper is clear. If you have 2 similar firms, but one's cheaper, the value investor leans towards the cheaper one.
Makes sense.
The core belief is that the market eventually figures it out. It recognizes the true value, the price corrects upwards, and the patient investor gets rewarded.
Patience seems key here. And the paper mentioned a big name to illustrate this, doesn't it?
Oh yeah, absolutely. Warren Buffett, he's like the icon of value investing.
Berkshire Hathaway, right?
Exactly. His company beat the S&P 500 in, 27 out of 31 years between 76 and 2006.
Wow.
Yeah, with an average annual return over 11%. That kind of long-term success really shows the potential of, buying good businesses at fair prices and just holding on.
Conviction the value wins out.
Yeah.
Okay, so we're hunting for these potentially mispriced companies. The paper looks at 4 specific ones to make this real. Why those 4?
Good question. So they picked Microsoft and Apple tech giants, and Pfizer and Merck, big pharma. The idea, and this is useful for you thinking about trading, is that they're all top-tier companies, right? Blue chips.
Okay.
But they've had pretty different histories, different trading figures, so that variety makes it a great test case to see how value principles might apply differently.
And they didn't just look at stock price fluctuations, I assume. What metrics did they use?
No, they went deeper. They looked at fundamentals. First, EBIT total revenue ratio.
Okay, what's that tell us?
Think of it as core profitability. Before interest and taxes, how much profit does each dollar of sales generate? Higher is generally better, more efficient.
Got it.
Then, earnings per share, EPS. That's profit per share of stock. Crucially, they tracked how it changed over time. Growth pattern.
Profitability growth, okay.
And finally, total revenue. Just gives you a sense of scale, market share.
And the time frame.
They focused on 2019 through 2022.
Right. And what was the big picture? Did these metrics show anything overall for these companies during that time?
Well, interestingly, the paper notes that for all 4, both that EBIT revenue ratio and the EPS were generally trending upwards between 2019 and 2022.
So generally improving performance across the board for these big players.
Seems that way, yeah. Suggests that underlying businesses were getting stronger during those years, generally speaking.
Okay, let's get specific then. Microsoft. What did the analysis show there?
Microsoft, it really stood out for having the highest EPS overall during that whole period.
Consistently high earnings.
Yeah, their EPS grew steadily from about $5.82 up to $9.72. And their total revenue also showed solid growth, 143 million up to 211 million. Very stable expansion.
So for a value investor, that kind of consistency might signal strong fundamentals, maybe less perceived risk.
Could be, yeah. Depends on the price at the time, of course, but strong, consistent performance is definitely attractive.
How about Apple, the other tech titan?
Apple was interesting. They had the biggest total revenue by far.
Huge numbers.
Massive. It jumped from 260 million to nearly 400 million. 394 million, actually. The biggest leap was between 2020 and 2021.
And did earnings follow?
They did. That period of rapid revenue growth, it lined up with their biggest EPS increase, too, from just under $3 up to $6.15.
So rapid growth. A value investor might see that and wonder, is the market pricing this growth in fully? Is it sustainable?
Exactly those kinds of questions. Is the current price justified by this growth, and what's the outlook?
Okay, strong stories from tech. Let's switch to pharma. Pfizer,
a more, let's say, dynamic picture. Their stock price was generally rising, but they actually had the lowest EPS of the four in 2019 and 2022.
Oh, interesting. Lowest EPS but rising stock.
Yeah, and total revenue bounced around more, started at 51 million, dipped in 2020, bounced back in 21, hit 100 million in 22.
So less stable on the revenue front.
And the ETS fluctuated even more, from 2.88 down to 1.65 for 2 years, then this huge jump to 5.59 between 2021 and 2022.
Wow, that's a big leap at the end. Something clearly happened there.
Definitely. That's the kind of thing a value investor would dig into. What drove that sudden surge? Was it sustainable?
Right, a more volatile story. And Merck.
For Merck, the paper indicates, well, a general upward trend for both EPS and total revenue.
Okay.
The specifics aren't detailed quite as much, but the overall direction was positive. Maybe a steadier, less dramatic growth path compared to Pfizer.
Gotcha. Now, the paper also compared the growth rates, not just the absolute numbers, but how fast they grew. What did that comparison reveal? This seems important for spotting opportunities.
Absolutely. This is where it gets really interesting, especially for thinking about your trading strategy. While they all grew, the pace was different.
How so?
Okay, look at total revenue growth over the 4 years. Microsoft and Apple averaged around 14–15% per year.
Okay, so.
Pfizer averaged nearly 33%, much higher rate. Merck was lower, around 8.5%.
Whoa, Pfizer's rate is way higher. Why?
Well, the paper makes a key point here. Pfizer started with a much smaller revenue base in 2019 compared to, say, Apple.
Ah, right. So a smaller number growing can show a bigger percentage increase.
Exactly. Even if the dollar amount increase isn't as huge as Apple's, the percentage jump looks massive. Remember that near doubling of Pfizer's revenue between 2020 and 2021? That massively skewed their average rate upwards.
That makes perfect sense. Okay, what about the e-tail's growth rate? Similar pattern.
Similar idea, yeah. Average EPS growth rates were about 20% for Microsoft, 30% for Apple, then Pfizer, a whopping 46% average, and Merck, around 23%.
Again, Pfizer way out front on the average rate.
Yeah, but it's also worth noting, both Pfizer and Merck saw their EPS dip in 2020.
While the tech companies didn't.
Right. Microsoft and Apple kept growing earnings that year. So these differing patterns across sectors and companies, they signal different kinds of maybe opportunities, maybe risks for an investor.
And how did the paper explain these differences between tech and healthcare growth?
It points to a few things. First, just the nature of the industries. Tech often has rapid innovation cycles, right? Changing consumer tastes. Can drive fairly consistent growth if you stay ahead. Healthcare, though, it's more regulated. Growth can be lumpier, tied to drug discovery, approvals, policy changes. Big breakthroughs can cause sudden surges.
Like maybe a vaccine.
Exactly. The paper mentions external events like the pandemic obviously having a huge sector-specific impact, especially for Pfizer.
Right.
And it comes back to that initial size thing, too. Smaller base revenue in healthcare can make percentage growth look higher. Lots of factors.
Okay, so let's tie this all back together for value investing and, importantly, for our listener thinking about their trading. What are the main takeaways? What strategies does the paper suggest?
Well, the conclusion has a really potent point, directly relevant for your trading plans. It suggests that the companies that started out with lower EPS and lower total revenue back in 2019.
Pfizer and Merck in this case study.
Correct. They actually saw the most rapid growth over the next few years, which potentially could have meant higher returns for investors who spotted that potential early.
Ah, interesting.
And the paper links this directly to a core value investing idea, favoring options with a lower acquisition price.
Okay, so it's not just about a low stock price number itself. It's about companies maybe earlier in their growth curve or smaller players, But with strong signs, they can expand significantly.
That's the idea. The logic is, if you buy something as stock for less than you think it's truly worth down the line.
You build in a margin of safety.
Exactly, that safety buffer. But you also set yourself up for potentially bigger gains if and when the company grows and the market valuation catches up to that underlying or intrinsic value. The paper stresses that value investors need patience. You need to look past the noise, focus on long-term fundamentals, look for those overlooked businesses.
And the fact that the highest average growth rates, both EPS and revenue, came from the companies that started lower in 2019, that seems to support this approach, at least in this study.
It definitely underscores that potential, yeah.
Yeah.
It suggests strategy. Actively look for firms that might be smaller now or maybe face challenges that depress their metrics.
But crucially, they need strong fundamentals underneath.
Yeah.
And clear ways to grow in the future.
That's the key distinction. It's not just buying cheap stocks, it's buying good companies cheaply, companies with real potential.
Right. But the paper also adds a note of caution, doesn't it?
Oh, absolutely. It's crucial to remember value investing isn't magic. It's not guaranteed profit.
Figuring out the true worth is hard.
Very hard. And the market doesn't always cooperate, right? It might ignore value for a long time or forever. So successful value investing means constant analysis, reassessment, being adaptable. Things change.
Dynamic. Okay, so wrapping this up for our listener focused on their trading plan, what are the core value principles we saw play out here?
The core is still Gilly. Find companies undervalued by the market relative to their long-term potential. The case studies just show different flavors of that. Microsoft and Apple. Consistent growth from market leaders. Pfizer and Merck. Rapid growth from a lower starting point, potentially higher returns, but maybe more volatility or uncertainty early on.
And the strategy suggested by this paper's findings for you, the listener, might be to look beyond just the biggest names. Explore companies perhaps starting smaller, revenue-wise or earnings-wise.
Yeah, if they have those strong fundamentals and clear growth paths.
Right. It lines up with that classic value idea.
Yeah.
Get a good price today for tomorrow's potential.
Precisely. Trying to find where today's price doesn't fully reflect the future value.
Okay, so considering everything we've discussed, the dynamic markets, the need for deep analysis, here's the final thought for you as you think about your next trades. How might you identify those potentially undervalued companies today that also have that strong growth potential? What do you need to look at beyond just the current price or even past growth rates? Maybe digging into the business model, competitive advantages, industry trends, management quality. What signals a truly overlooked gem with real upside? Lots to think about there. Thanks for tuning in to this deep dive.
Thanks for tuning in to BSB's Deep Dive. If you enjoyed today's episode, make sure to follow, rate, and share this podcast with your fellow knowledge seekers. Keep learning, keep growing, and I'll see you in the next one.